While investors are fighting over properties in regional Queensland, Melbourne and Perth, there's a capital city that has been quietly building momentum without making any headlines. Darwin, Australia's northmost capital city, has largely been ignored for nearly a decade, but here's exactly why it might be the best investment opportunity in 2025. Today, I'm going to reveal why smart investors are already positioning themselves in Darwin and how you could be ahead of the curve on Australia's next property hotspot. First, let's address what you're thinking already. Isn't Darwin the market that crashed and never recovered? You're right to be skeptical. Darwin's property values are still lower today than they were in 2014, but that's exactly why it presents this perfect opportunity. So let's examine the data in detail. According to CoreLogic March update, Darwin was the only capital city to record a decline in the housing value in February, down 0.1%. But this isolated monthly figure masks the broader trend happening in the market. When we analyze the quarterly data, values are up 0.7% over the past 3 months and 1.5% over the past year. What's particularly significant is that Darwin's house values are just 1.5% below their May 2014 peak. After a decade of stagnation, they're finally approaching recovery. To put this in perspective, Darwin house prices peaked at approximately $570,000 in 2014, then fell to a low of around $460,000 in 2020, and now climbed back to around $560,000. Digging deeper into the price segments reveals something even more compelling. The most affordable 25% of Darwin's properties rose by 2.2% in the last quarter, while the premium end fell by 2.7%. This price divergence is a textbook early indicator of the market beginning to turn. It shows us that investors and first-home buyers are already moving into the more affordable segments, creating the price pressure from the bottom up. This pattern aligns perfectly with the property market principle of reversion to the mean. Historical data consistently shows that after extended periods of poor growth, markets typically experience above average growth in the subsequent years. Let me give you 2 clear examples. Perth, from 2014 to 2021, grew by 0.2% annually on average, but from 21 to 24, Perth delivered average annual growth around 12.8%, including a remarkable 15.2% in 23 alone. My second example is Sydney. From 2005 to 2012, Sydney grew by merely 1.38% annually. Yet in the following 5 years, it averaged almost 14% growth per year, nearly tripling the value of many properties. This pattern isn't a coincidence, and Darwin is in the perfect position at this inflection point right now. So why am I bullish on Darwin after such a long period of underperformance? Well, let me break down into the market indicators and the long-term growth drivers that I see. Starting with the market indicators, we're seeing clear signs of momentum. Properties in Darwin have dropped from spending 70 days on market last year to just 45 days right now, a significant 35% reduction. When days on market drop below 50 days, it's typically signs a market's ready to move. Sales volumes have increased by 27% over the past year, with supply constraints becoming evident as new listings have fallen by 36% year on year. With only about 1.8 months of supply available at current absorption rates, we are well below the balanced market threshold of around 4 to 6 months. But what's truly exciting about Darwin is how it's finally diversifying beyond mining. Defense spending is ramping up with a combined $747 million investment from the US and Australian governments. The Darwin Shiplift Facility, a $515 million project, will create over 400 permanent jobs when completed in 2026. Charles Darwin University's new $250 million city campus opened last October, bringing in 1,100 students into the CBD daily. The $5.8 billion Barossa Gas project will extend Darwin's LNG operations life by over 20 years. And the recently approved $20 billion Sun Cable project will connect Darwin to Singapore via undersea cables, exporting solar panels. These aren't just projects on paper, they're creating real jobs right now. Darwin's unemployment rate sits at just 3.4%, well below the national average. Job listings have increased 22% year on year, with strong growth across healthcare, public admin, construction, and professional services. After 5 years of population decline, Darwin is finally growing growing again, adding over 2,300 residents in the past 2 years. Meanwhile, housing supply remains at a critical constraint. Only 350 new houses and 60 units started construction last year, the lowest level since records began in 1985. With construction costs up 31% since 2020 and developers' confidence still recovering, the Urban Development Institute estimates Darwin faces a shortage of around 2,100 dwellings for the next 3 years. These supply and demand imbalances have created Australia's highest rental yields, 6.7% for houses and 7.8% for units. Compare that to Sydney at 3% and Melbourne at 3.2% for houses, and you see why cash flow investors are starting to take notice. Rents have surged too, with houses up 12.2% year on year to $645 per week, while the vacancy rates have just tightened to just 1.1%. But let's address the elephant in the room about Darwin, because understanding this risk is essential for any serious investor. Darwin's property market has historically been very volatile, with a peak to trough swing of almost 70% during the last cycle, the most extreme of any Australian capital city. However, today's economic drivers are more diversified across multiple sectors rather than tied to a single mining boom, suggesting future growth may be more sustainable. With a population of around 142,000, Darwin is Australia's smallest capital city, just 0.5% of Australia's total population. This creates liquidity risk during the downturns and can amplify price movements in both directions. You need adequate cash reserves to weather potential extended sales periods if the market slows. Darwin also has Australia's most transient population, with an average period of just 4.2 years compared to the national average of around 7.5 years. While this creates higher tenancy turnover, it also drives consistent strong rental demand, explaining why Darwin has leading national yields. Finally, the tropical climates presents a unique challenge. The wet season brings cyclone risks and extreme humidity, requiring specialized property management including regular pest inspections, mold preventions, and more frequent maintenance. Insurance premiums typically are around 30 to 40% above the national average in Darwin. These factors explain why Darwin has often been overlooked, but this also creates opportunity for knowledgeable investors willing to take those risks. Markets with a higher risk tolerance often deliver superior results to compensate for the additional risk. Now here's my strategic framework for approaching Darwin based on the data analysis and the on-the-ground research. Focus on houses rather than units. They're just 1.5% below their 2014 peak, while units remain about 16% below their peak. With construction costs and land constraints limiting new supply, houses offer a greater scarcity value, and their rents have grown faster at 12.2% year on average. Target areas connected to major infrastructure, particularly Palmerston suburbs like Sokoli and Ballamark, which show remarkable resilience during the previous downturns. Suburbs along Tiger Brennan Drive benefit from a reduced commute times following the 2023 expansion. Barramar is strategically positioned between the CBD and Palmerston with the new industrial development. I will also recommend to follow defense and education investments. So suburbs near the RAAF-based Darwin like Lyons and Maryhead, and areas surrounding Robertson Barracks such as Rosebery and Belmark are expected to house an increasing number of defense personnel. Properties within 1K of Charles Darwin University new campus also show strong potential for consistent rental demand. When selecting properties, prioritize features that appeal to government and defense tenants. They stay on average 75% longer and have a significantly lower default rate. Look for a 3 to 4 bedroom house with a covered outdoor area, secure parking, and comprehensive air conditioning. Prepare for Darwin's climate changes by selecting post-1975 properties built to cyclone and code, budgeting for regular maintenance, and secure appropriate insurance coverage. Most importantly, adopt a medium-term investment horizon of 5 to 10 years. The first 2 to 3 years will deliver strong cash flow, while the highest capital growth potential will come as the economic projects mature. Darwin isn't for everyone. It's a high risk with potential higher reward. If you need immediate capital growth or can't tolerate some volatility, there are some safer options elsewhere. But let me put Darwin's opportunity in perspective. The median house price is just $560,000 compared to Sydney's $1.38 million, while delivering more than double the rental yield at 6.7%. You only need $95,000 income to service a mortgage there versus $235,000 in Sydney, and the price to income ratio is just 5.1. So what's your take on Darwin? Have you considered investing there? Drop a comment below to let me know your thoughts. And if you'd like me to do a deep dive analysis of Melbourne next, please just comment Melbourne below. For those who see Darwin's potential like I do, book a personalized strategy call with me. During our 30-minute session, we'll analyze your investment goals, risk tolerance, and budget to identify specific Darwin's opportunities aligned with your strategy. This is Wilson Yuan, and I'll see you in the next video.